I'm here in Riga at the headquarters of Eleving Group and talk with Maris Kreics, CFO of Eleving Group. Hello, Maris.
Hello, Christian. Nice to meet you. Nice to see you.
Thank you. You went public in October last year. What changed for you as a result of the IPO?
Okay, thank you for the question. So there are certain important things that have changed for our company. So firstly, that's the improved balance sheet, substantially recapitalized balance sheet,
Yes.
improved equity ratios. Now we're standing at comfortably about 20% if we look at the financials as of the end of last year. And on the capitalization ratio, we're close to 30%. So that's the first thing. And I believe also quite important for our bondholders simultaneously because it essentially de-risks the company's credit profile. Then the second thing is also that we have also become more transparent in terms of our mid and long-term goals. We have published them in our webpage. We have also published our dividend payout policy. So this is no longer kept kind of in a secret. It's a very public dividend policy, which is subject to the company's capitalization. And so these are two main things. And maybe the third one, which I can add, is also the fact that now we have an independent supervisory board since the beginning or since the middle of last year. So that also improves the company's governance. And also, we believe it's a positive message to all our stakeholders.
Okay, you also increased your 2028 bond. How you want to use the capital?
Yeah, so as already mentioned in the bond documentation and also in the marketing materials for our investors, the primary placement of the newly attracted or raised capital is going to be investment into our net loan portfolio. But our balance sheet is actually quite unique because it allows us in a short term also prepay and repay some part of the most expensive liabilities that we have in the balance sheet, and we will definitely use that option. But ultimately, all the money raised will be eventually placed in our loan portfolio.
Okay. At the recent capital market transactions, you placed significantly more in the Baltics than in Germany. How important is the German capital market for you?
Yeah, so I would say German capital market and German investors remain vitally important to our company and our group. The recent transaction, I would say, is not a good proxy in terms of our investors' community as such, because the recent bond placement was actually more tailored towards Baltic investors. And if we look from the offering details, also if we look from the syndicate members involved, and our idea as a company was to really tap into this demand or the appetite for high quality, high yield bonds in the Baltics. And we really did that, and the bond issuance was a successful one. So I would say the recent bond transaction was purely Baltic focused, and it also showed in the results. But at the same time, we will be active in the debt capital markets in short term, mid term, long term. And I believe that the following bond program that I believe we also going to touch upon later, it will be more geared towards also international investors, including German investors, and I believe we're gonna raise substantial amount of capital from Germany as well there.
Okay, you want to grow strongly in the next years. Which regions are you focusing on?
Yeah, all right. So let's say our growth actually comes from three core pillars. So one is growth in the existing markets through existing product portfolio. So that means we're going to grow in the markets where we are currently present, and let's say more than half of our net loan portfolio is already invested in European markets. So we're going to grow in the same markets where we are. Secondly, we also plan to open new markets, and these new markets, I don't want to kind of disclose too many commercial details right now, but I think I can with confidence say that one or a few markets we're looking at would come from African region. Yeah. At the same time, we also have few opportunities here to enter in markets in European region. So it will be a balanced entry into the new markets from geographical perspective. And lastly, also one important aspect is we plan to grow by introducing new products in the same existing markets. Mm-hmm. So as you might know, We have certain markets where we're only present with consumer loans and certain markets where we're only present with vehicle loans. So we would like to also introduce in the vehicle markets more consumer loans and vice versa. So that's the third pillar of our growth.
With the activities in Africa, you are not developing more and more into emerging markets?
So I would say that if you look at our company, where it stands currently and where it was 6 years ago once we did the very first Eurobond issuance, of course the company has developed outside of Europe substantially. But I would say our goal is not necessarily to go into emerging markets per se. What we're looking for markets with untapped potential, with underserved customer base, and this is where really we see our products thrive. And we're still looking for the markets with the best risk reward and effectively yield for our company, for our stakeholders, shareholders, bondholders. And that, to some extent, warrants our presence in the more emerging markets. But I would say in a mid and longer term, it will still be a balance. We might enter more into emerging markets in a near term, but in a longer term, we see this as a balanced company, balanced from a, let's say, geographical perspective, also from product perspective.
Okay, and how can you avoid FX risks in these countries?
Yeah, so let's say risks we're not necessarily trying to avoid, but the first line of defense is actually pricing every single risk in our product offer. So this is the very first line of defense for us and our company. So the same product in the African market would actually be priced at a higher price than it is, let's say, in Europe market without FX risks. So that's the first line of defense where we build up the profits and equity so we can sustain any unforeseen currency fluctuations. The second line of defense for us is trying to manage the open foreign currency position by borrowing locally from local lenders in local currencies. By doing that, we are actually minimizing the open foreign currency position, which is created by us issuing loans in local currencies. And I need to say that we have been very successful in doing that because we have raised tens of millions euros in a market such as Kenya, Botswana, Namibia, all money raised from local lenders in local currencies. And lastly, I need to mention that the third aspect, how we manage the still open currency position, which is not hedged by natural hedges, these borrowings in local currencies, we manage that remaining position by purchasing derivative contracts. So we enter into non-deliverable forward contracts from currency perspective, and this is the way how we, let's say, close the remainder of the foreign currency position that it is in our company.
Okay, and the next big point for you as CFO is to refinance the 2026 bond. When do you plan to refinance this bond?
Yeah, so we are actually looking at the time frame which would be still this year. Our plan as of this moment would be to engage in investors pre-sounding, let's say non-deal discussions, non-deal roadshows with the potential investors, also discussing the approach with certain banks. So we're still at the stage where we're going to be picking the specific banks and syndicate members for this possible transaction. But according to our time frame, we would like to have a clarity on that by the beginning of summer. So then we have all full summer to work on the specifics of the deal and be potentially ready to come to the market either in the third or fourth quarter of this year. Still worth to mention that we have plenty of time to refinance the bond because the bond matures in October 2026. But we would like to get the clarity for us, for the company, for our bondholders, stakeholders, everyone involved as soon as possible. So potentially we're looking at the capital markets transaction which would happen this year.
Okay. And which growth you plan for this year and for next year? Yeah,
so here I can refer to our published growth plans in our webpage. And these plans have also been communicated through our IPO process. And I can say that our plan remains unchanged. We have met our goals for year 2024 that we set for ourselves. And now if we look for the year 2025 and 2026, so we would still be looking at approximately up to 20% growth in net loan portfolio, correspondingly also in revenue for both each of those years. and most likely and possibly higher growth in the profitability metrics.
Okay, thank you for the interview.
Thank you.